Welcome to the GrowthCap podcast, where we chat with CEOs, investors, and other key industry leaders to uncover insights and strategies for accelerating growth and succeeding in business. I'm your host, RJ Lumba, Managing Partner of GrowthCap. In this episode, we chat with Dave Welsh, Head of TMT Growth Equity within KKR's private equity platform. Dave is an industry veteran and shares with us his strategy for growth investing, as well as insights for limited partners to consider as they invest across economic cycles. We hope you enjoy the show. So Dave, thanks so much for joining us for this conversation. Maybe what we could do to kick off for our audience is to give a little bit of background on yourself and up to your current position with KKR.
Yeah, sure. Thanks, RJ and Peter, for having me. So I joined KKR 2 years ago. My background goes back to really the mid-'90s. I was a executive at a Axel portfolio company starting back in the mid-'90s. I was in the internet infrastructure space. Company ended up going public in the late '90s. Ended up being actually the second largest return in Axel's history outside of Facebook. That company was called Portal Software. And ultimately got sold to Oracle and is now a large part of the Oracle software stack. So I went from there into private equity. I actually took a guy from General Atlantic Partners, who's now at GGV, named Glenn Solomon, was helping BNP Paribas, if you know the French bank, had a venture arm out in the U.S., Partech Ventures, and they were starting a growth effort, and Glenn had really led that up, and Glenn recruited me to come there, and that was in 2000, and I was there from 2000 to 2007. An interesting time, as you can imagine. I saw the crash happen, and sort of worked through a couple of years of pretty tough macro environment, but it was a great time to learn the business. In 2006. Partech, as it started to become known, decided to go back to its early-stage venture capital roots. I left. I went and I became a person I'd got to know both personally and professionally named Dave DeWalt, who later became the CEO of FireEye, was becoming the CEO of McAfee, and he recruited me to become the Chief Strategy Officer at McAfee. So I was the Chief Strategy Officer at McAfee from 2007 to 2008, and decided relatively quickly I wanted to get back in investing, and I left McAfee in 2008 to join Adams Street Partners, which is a large fund of funds out of Chicago, and they were starting a direct growth equity team out here on the West Coast, and I joined that to help build that up, and I did that from 2008 to 2016 when I joined KKR to help them do a similar thing and build out their growth platform here at KKR. So that's how I got in the seat I am today.
Great, thanks for that background. And it sounds like you've been around the space for some time. Maybe what we could do is jump right into, what you're focused on now. Maybe some of the key kind of characteristics you look for in an opportunity, and maybe how that's different or the same than what it was in some of your previous investing roles.
Yeah, no, right, thanks. So we're looking really for a few things that are common, which is, big markets, very compelling solutions, great management teams. So those things I think are consistent across all the places I've invested. I think at KKR what we're looking for a little more than that is really companies that have aspirations to be very large global enterprises. So I'm looking at a little bit later stages than I was in my previous roles, really for companies that, are in the multiple tens of millions of revenue typically and are starting to scale. And really both existing investors and existing management team have aspirations to make something quite a bit bigger. So we're not looking for things where there's a kind of straight line shot to, an acquisition or even a quick IPO necessarily, but rather, something where the company can expand, quite significantly from where they are, and utilize a bunch of the resources that KKR as a global private equity firm can bring in helping them grow the business substantially. So I'd say there's commonality in some of the basic building blocks, which is great management teams, good markets, good product, And then there's sort of this added piece, which is we're looking for things where there's really large opportunities, and importantly, existing investors and teams that have the motivation to want to try and really go the long haul, and take advantage of those.
Got it. Yeah, it's really difficult. We speak with CEOs, various CEOs daily, and I know it's difficult for them to navigate if they haven't been through that capital raising process before and have spoken to growth equity investors who are probably less prevalent, or that investment style of growth equity is less well known than venture capital. But one thing that I thought was interesting was I caught your blog about getting the most from your growth equity investors, and it did seem like what really came through there was that there's the potential if one kind of looks at KKR and in particular the group you run, there's certain advantages that a CEO could get because of the one part, the deep network and the experience. Maybe if you wouldn't mind spending a little bit of time kind of talking about the kind of maybe the uniqueness of the platform you're part of.
Yeah, no, thanks. I mean, it's why I'm here, right? I really, when I thought about coming over here, I was pretty happy where I was, and I kind of thought to myself, initially, why go someplace else? Why go to a place that's starting another growth equity platform? The world's got, more than a couple of them, and really the reason I did it was because I do think, as you said, that there's some unique attributes that KKR brings, and I really think they're, pretty differentiated. So, one of those is as I already mentioned, we've got a very, large global footprint, and so that comes in a couple ways. We've got a very large enterprise portfolio from our private equity side, over 100, large enterprise companies that we own through our buyout portion of our business, and those are really excellent connections to some of these growing companies, both in terms of potentially partners or even being customers, but probably equally importantly, just getting access to some of those other executives. We have forums where we help facilitate discussions among our portfolio, and that includes our growth portfolio, and allowing some of those smaller companies to have access to that larger enterprise portfolio of KKR is really helpful, just to kind of answer a lot of those growth questions for them. And then I'd say the other piece globally is we've got offices across 16 countries, and groups within each of those offices that are really focused on the operations side of the business and helping companies expand globally. And so a big piece of what we do in all of our companies, but on the growth portfolio included, is we really help those companies navigate where and how they can go internationally, and utilize those on the ground resources in all those countries to help them do that, or not do that, depending on sort of the right timing. So that's kind of one piece of it. I think another piece of it is, and it relates to what I just talked about, the people on the ground. We have a fairly large operations group called Capstone. It's close to 60 executives that are former McKinsey, Bain, BCG consultants that work with our portfolio on lots of different scaling issues, things like go-to-market, supply chain, channels, compensation, and we utilize them in a different but effective way with our growth portfolio as well as our PE portfolio. And I say different because we have to be mindful that some of those growth companies are still relatively small in resources, and so we can't drop too much on them too quickly with our operations group. But we do enough, and we do it in bite-sized ways that they can really take advantage of it as it makes sense for them as they continue to evolve. And then I guess I'd say the other thing that we have that's pretty unique to, well, I think it is unique to the growth equity world, is we actually have a very large capital markets group that places several billion dollars a year in debt and equity financing. And so we actually have them help kind of talk through with our growth portfolio companies, what are your financing alternatives as you continue to mature? What is the market really looking for if you're thinking about doing something like an IPO or a debt placement, and ultimately even helping them in doing that. So those are some of the things that are I think different about our platform compared to other growth equity firms, and where we think we can really add differentiated value to the portfolio companies we invest in.
Yeah, that's truly unique. It seems like a fairly comprehensive platform. Was curious to do, if you often find that companies can quote unquote or graduate, from maybe the growth fund to private equity fund or another pocket of capital within KKR. It seems like you can almost offer both, the initial capital, the advisory on capital markets, as well as possibly even to obtain funding from another capital source within the KKR.
Yeah, that's right. I mean, I think that's the idea. One of the concepts we have is that we want to be, the, financing and strategic partner for these portfolio companies across a very long-term relationship. And so, as you mentioned, it's something where we really hope, and no matter what their financing needs are, whether it's, as you say, through us directly or through, facilitation of partners that we have, that we can really be there to help them go through all the stages of financing after they've engaged with us in an initial investment.
Got it. And what do you see are the kind of the more interesting trends? And maybe we'll take this first by vertical. Like, what are some of the interesting trends that you see in the TMT space that you're most focused on?
Yeah, I mean, I guess probably not unlike a lot of people, we're very focused on the software, sector generally. I think we spend time and we break that down into, lots of different areas. I think we've spent a lot of time the last, I'd say, couple of years in places like security software, like DevOps, vertical software in certain industries, analytics. So I'd say very broadly, we look a lot at B2B software, and in particular, places where there's good, solid recurring revenue models. So that's one, general area for us. We have done both here and over in Europe some, larger scale consumer internet related investing. So two examples in particular, Lyft here in the U.S., and then a travel business called Get Your Guide out in Europe. So we continue to look at that sector as well. And then, we sort of, beyond that, we're pretty opportunistic in the other places that we look. So we really, because we're looking for, what we think are very already well-established, scaled businesses that have shown sort of good, product market fit. On the one hand, we want to be tops down and sort of looking at things from the thematic perspective, but the other side of it is we're trying to be opportunistic, and as good businesses come up in other, kind of tech-related sub-industries, we certainly look at those as well. What we haven't done, kind of categorically, is we've not really done a lot in the, hardware, sort of harder core, kind of components in that area. That's an area that for us has still been a little bit, kind of off the path. But we continue to consider whether places like that would be something we would do long term, but just hasn't been something we focused on so far in this fund.
Mm-hmm. Well, you chose a great investment in Lyft. I actually knew John Zimmer during his college days. He a very talented guy, and I remember when he was first telling me about the idea of Lyft. At that time, it was carpooling. He kind of had this vision that people, and it started, kind of, I think, with his own personal experience, just kind of trying to get from home to college, and just saw that the environment also was at risk if there was too many cars on the road. So it's interesting to see how that evolved, but no surprise that he's still doing extremely well with the business.
Yeah, it's interesting. There's actually, an interesting combination story there. He and Logan, the president CEO of the business, had the same idea, literally polar opposite ends of the country at the same time. So Logan was at UC Santa Barbara, while John was up at Cornell, and they frankly had almost the identical same idea. And I won't go through the whole story, but the really almost endearing story as to how they ultimately came together to share that idea and have become, just super close friends and business partners, and be real visionaries of that industry.
Yep. Maybe then switching gears a little bit and talking about the growth equity space in general. I think having seen it from kind of maybe more of a macro perspective. At Adam Street, where do you think it's, or how have you seen it evolve?
Yeah.
And where do you think it's headed?
Yeah, it's a good question. I mean, how it's evolved, I think it's gone from something that was unformed and frankly no one really knew kind of that there was a growth equity space in the way that we've now kind of all categorized it 10 years ago to something that's a kind of a normal and natural now sort of defined part of the industry. And I think it makes sense. I think if you look at kind of the landscape of things and sort of what early stage venture capitalists are good at and where they really add value, it's quite a bit different than what people that would come in later in the growth equity stage, how they look at things and the way they add value. So I think it started with sort of some dabbling by some early stage firms into it, and sort of maybe some sort of hedge funds or crossover firms coming down into it, and now it's I think becoming pretty well established that there's a group of firms that this is where their focus is and this is what they do. So I think it's matured at some level into a real industry, over the last 10 years and certainly over the last, call it 3 to 5 years. And I think it's here to stay. I mean, I think it's a good and probably necessary part of the overall ecosystem of companies as they, mature from startups all the way through to, public entities and beyond. Where we are in the cycle obviously is a lot tougher question. I think it's probably safe to say we're somewhere closer to the top of a cycle than a bottom. Whether we've are topping out and exactly what the time frame is on that, I think those are kind of questions of speculation that it's always hard for me to try and guess at. I think what I can say is we are certainly as a group and as a firm preparing ourselves for some element of a downturn in the cycle here over the next couple of years. And what does that mean? It just means backing businesses that we think can sort of have very good business models and persevere if there are some cyclical downturns. And two, really being prepared that when there is a cyclical downturn, that there's a lot of businesses that we've known that we've really liked that maybe we were sort of steered away from investing in because the valuations had just gotten way ahead of themselves. But if there is a downturn and valuations, correct into something a little bit more to historical norms, that we'd be ready to jump in and invest in those. So I don't try to guess exactly when that's going to be, because I think that's always, a really tough thing to do. But I do think we're confident in enough that we're closer to a top than not, that we're getting ready for, what that might look like on the other side.
Got it. So if you're an LP right now, do you kind of sit tight and hold on before putting money back into the growth equity space, or do you kind of just shift what you focus on within growth equity?
Yeah,
I mean, we're putting our LP hat on.
Yeah, no, I mean, so here's the way my colleagues at Adam Street really talked about things, and I think this is kind of right. I don't think as an LP you should ever try and time markets. And so I think as an LP you just want to be consistently coming in to, kind of what you consider to be top of class investors, and just do that over time and assume that the top of class investors will know how to modulate their investing appropriately. And so for me, if I was an LP, rather than trying to, kind of speculate, are we somewhere, again, near a top or not, I would say, if I was setting out a plan, I would say I, should be consistently putting dollars, at work across all cycles. And, I should do that, when things are going well, and frankly should be doing that even if things start to turn down, because, investing in funds that get raised during some of the down cycles are often the absolute best funds to be in. And so I think that's, to me, if I was an LP, I would focus a little less on where are we on a cycle, or is a category overfunded, or what, and rather just be diversified, by both time and by names, and just be consistent. Timing, kind of private equity markets in any of the categories is really, really hard. And so, I think that's the best advice that I give to LPs, is just, if you're going to create a program, create a consistent program and stay with it.
That's great. That's very helpful. We've got a good number of family offices, as well as institutional LPs in our audience. So, that'll be, insightful for them. And then one more on that front. Where do you see, it's interesting, Cambridge Associates puts out kind of their data, I think quarterly. analyzing kind of the segments, kind of LBO or buyout shops versus growth equity versus VC, and it seems that growth equity has been outperforming. Do you think that continues?
Well, I mean, I think over the long haul, the kind of performance of each of those categories, has its cycles, and will have its ups and downs. And so whether over a 10 or 15 year period, growth equity sort of outperforms the two other asset classes, I don't know. I have no idea. I think it will be close. I think they'll all be within a fairly bounded range. I think the thing that's, to me, probably more interesting is the variability inside of each asset class.
Mm-hmm.
And so, if you look at VC broadly, the first quartile versus the fourth and fifth quartile, the variability there is, as very high. Whereas in growth equity, the variability between the first quartile and those other quartiles is quite a bit more bounded, and private equity even less so. And so in some of this, it really goes to this notion of, being in whatever the category is, sort of picking a set of names that you have, kind of good faith in and you think are going to be market leaders and stay with those. And it's particularly true as you go kind of up or down, however you want to say it, the risk curve, as clearly the variability, the earlier that you go in the asset class, is greater. So that's a long-winded answer of saying I'm not sure across all of those. I could try to speculate on who's going to have better very long-term returns. I think they'll be as a categorical class they'll probably be fairly close. But I think if you sub-segment it out, kind of the categories, you'd see a lot of variability as you went early and less as you went into growth and ultimately into PE.
Yeah, no, that's a really good point. Like overall in aggregate, they do tend to, if you take each of those segments, they tend to, all kind of hover around the same. But within each class, there can be dramatic differences, particularly on the VC side. Well, Dave, this has been great. Really appreciate the time you took with us. I know this is going to be very insightful for our audience. I guess before we sign off, anything that I may have left out that you wanted to mention?
No, I think I'm happy to have done it. I think it's great. I think you're bringing up really good questions about cycles and timing, and I guess my, as I already mentioned on the LP side, I think in general the philosophy that I would have is be consistent and just make sure that you don't get two ups in the ups and two downs in the downs. That's sort of the way in the long haul people have done well in this asset class, and so I would say that's the way that I think about things, and would encourage others that are in it to think about it too.
Excellent. Thanks so much.
Yeah. You bet. Yeah, thanks guys.